Good morning and welcome, everyone. Thank you for joining us here at Cherry Bekaert for our 2021 Government Services Seminar. My name is John Gilberto, and I lead Cherry Bekaert's governmental industry practice. I'm very excited about today. We have some great presentations and really great presenters, and we're going to be offering 4 one-hour CP sessions that you can sign up for individually. Today's agenda is very exciting too. We have, of course, your requisite GASB update. And as everybody knows, with the environment that's got there and the grants and all the things that are happening with COVID, we have a COVID update. And then on top of that, we have our top 5 IT hot topics, which is going to be important and kind of interesting for everyone. And then I'm very excited and very proud about our 10th annual benchmarking survey. This is hot off the press. You guys are going to be the first ones to get to hear and see the results of our benchmarking survey for our last 10 years. So I hope you guys enjoy all 4 sessions. And again, thank you for joining us today at Cherry Bekaert. And with that, I'm going to turn it over to our first moderator, Krista Edoff. Krista, it's all yours.
Good morning, everybody. So today we are kicking off our first session of the 2021 Government Services Virtual Seminar. I'm really excited to be here with you today. I'm sorry we're not live together in person. The second year now under COVID. Hopefully next year will be a different story, but I can see you at least via the chat, and I know many of you I work with on a pretty frequent basis, so hopefully I'll get to see you soon, even though not today. Let me first just briefly introduce myself. My name is Krista Edoff. I am an assurance partner at Cherry Bekaert. For our first session today, I'll be hosting, and I'm happy to welcome Laura Harden, who is an assurance director with Cherry Bekaert, and our Cherry Bekaert senior manager, Stephen Scheel. So they'll be presenting the GASB Standards update today. So just a few quick housekeeping items really before we get started. If you have any questions during the webinar, please type them into that chat window located in your control panel. Our speakers will leave a few minutes at the end of their presentation to answer any questions. If they're unable to get to any questions, again, please put them through the chat because we will have your information and we'll be sure to get them answered and get questions sent out to you. We do ask that you keep your microphone turned off for the duration of this event, just to prevent any static or background noise. And this one is really important. So to receive CPE credit, you must join via our Zoom's desktop application or the Zoom mobile app, not on your web browser, on your phone. So if you're currently using the web browser, please log out now and download the Zoom app by visiting zoom.us/download. CPE certificates will be issued via email within 10 days. If after those 10 days you have not received that certificate, you can email us at cbhlearning@cbh.com. In order to get the CPE credit, you will need to answer the polling questions that pop up throughout the course. We will be doing a recorded version of this webinar, and it'll be available in about a week. That link will be sent via email and posted to our website. So please reach out to our professionals if you have any follow-up questions regarding today's topics or any other aspects of your business. We're happy to help. Again, please use the chat if you have any questions. I'll be monitoring the chat throughout the presentation, and our administration will be monitoring for if you have any technical difficulties. We are 5 minutes really until 9 o'clock, but I'm going to go ahead now and turn it over to Laura Harden and Stephen Scheel to start the GASB update.
My name is Stephen Scheel. I'm going to go through the first half or so of the presentation before I turn things over to Laura to wrap up. All right, so first we're going to talk about Statement 95 issued in May of 2020, effective immediately. And this was to provide relief to local governments who were dealing with the COVID-19 pandemic at that time and continue to, of course. So this standard delayed the effective date of certain provisions of statements and implementation guides. The most impactful thing that this did was it delayed fiduciary activities and the lease standard, which most entities were planning to implement in 2020 and 2021, more or less, depending on your year end. And that got pushed a year out. So it provided some much needed relief for the governments whose work environment and such were impacted by the pandemic, and provided more time needed to implement those standards without being rushed and done with some errors perhaps. Statement 84, we'll spend a good amount of time going through this, even though there's not much in the way of an update to provide because the standard's been out since 2017. Sorry, somebody. Good. Okay. So fiduciary activities issued in 2017. The effective dates that you'll see throughout the presentation have been updated according to Statement 95. So what you see here is accurate as the latest implementation date allowed. Earlier application is allowed, of course. So 84, if you have prior period financial statements presented, they need to be restated. And the language from the GASB with most statements is that this is to improve some aspect of financial reporting. So in this case, fiduciary activities and how those activities are reported. There's a few definitions that are going to be in the slides that follow that I just want to go through up front so that we know what those terms mean. And the first one is control of assets. So what does it mean for a government to have control of the assets? They either have to hold them or they have to be able to direct the use, exchange, or employment of the assets. So that definition, what one would expect when they see the word control. Either it's in the government's possession or they have some say in how those assets are used. There's also a concept in some of the standards that talks to administrative or direct involvement that the government has over the assets. And indicators of that would be if they monitor compliance requirements, determine eligibility of expenditures, or can exercise some discretion in how the assets are allocated. And then there's a concept of own source revenues. And this again is what you would expect it to be. It's revenues that are generated by the government. It can be exchange or exchange-like revenues, utility charges, investment income. It can also include non-exchange revenues, derived taxes from sales and income, or imposed non-exchange revenues, property taxes. So like I said, just what you would expect from the name, it's revenues that the government is generating. This is really hard to see, but in the statement, there's a flowchart provided that walks you through a sort of decision tree on whether an activity is fiduciary or not. And so there's what looks like a lot of information here, but it's actually really helpful as a tool to use and go through and identify, is the thing that I'm worried about a fiduciary activity, or is it something else that needs to be accounted for differently? There's 4 paths within this chart, and we break them up and go through them one at a time in the following slides. Those 4 major paths are for component units that provide post-employment benefits, so pension, OPEB, component units that do not provide post-employment benefits, post-employment benefits that are not component units, and then everything else. So first, we're going to talk about fiduciary component units. Those are entities that meet the requirements of GASB 14 as amended to be reported as a component unit, and they're either a pension plan that reports under GASB 67, an OPEB plan that reports under GASB 74, or they're a pension and OPEB plan with assets from an entity outside the reported entity. Those are the main ones that most people are going to see when they're dealing with fiduciary component units under GASB 14 or under 84. There's also a component that deals with component units that don't have post-employment benefits and deal with other assets. I don't see this one being very common, so we're not going to go into all the details here, but be aware that that's one of the categories that has to be considered when you're analyzing your activities. Okay, so again, here's the full flow chart with a section in the middle that highlights the fiduciary component unit piece. And so if we step through that flow chart one piece at a time, you answer the questions and go on to the next. It's really helpful as a tool to not have to go through the actual text of the standard and use this as a more visual aid. So first question, are the assets held separate by a separate entity that meets the definition of a component unit? If yes, next step. And the no response here is cut out, so it doesn't make sense on its own. But if you look back to the full chart, if the answer to that question is no, you go elsewhere. So second question, if the first is yes, are the assets held for pension or OPEB arrangements? If yes, are the pension and OPEB plan within the scope of other GASB guidance? And if the answer to that question is yes, then you have a fiduciary activity. If the answer to that question is no, then you have to assess, are the assets from other entities that are not part of the reported entity? And then you would also have a fiduciary activity. So if the assets are for the government's own pension or OPEB plan, or if they're for another entity that the government's holding, in either case, they're reported as a fiduciary activity. If no, then it's reported elsewhere in the financial statements. Okay, so that was the first path. Nothing really groundbreaking there, kind of what you expect and already have been doing in most cases, I would think. Second path is the one I mentioned that's not going to be very common. So this is for component units that are not providing post-employment benefits. Again, there's a section of the flowchart that deals with this. You go through and analyze. Not common. I'm going to move on to the next section. If anybody has any of these that you know of, I'd be curious to hear what they are, so feel free to comment so that we can get a pulse for what's out there. But otherwise, we're going to move on to the next path, and that's for post-employment benefits that are not component units. So, think if you're a general government and you have an OPEB plan that is not in a trust or another entity that's a component unit, you've just been reporting this within your financial statements. That's what we're talking about here. So again, the flow chart, we go through, and if the answer to the first question is no about it being a separate component unit, then you assess, does the government control the asset? If the answer is yes, is it for pension or OPEB arrangement? If the answer to that is yes, you identify whether the plan's within the scope of other GASB guidance. If the answer is yes, it's a fiduciary activity. If the answer is no, you go through the same assessment that we mentioned in the first section of the flow chart. If the assets are being held by the government for another entity, then it is a fiduciary activity. If it's not, it's reported elsewhere in the financial statements. And then the last category is for everything else that the government does. Again, the flow chart, we start with the component unit question. No. Does the government control the asset? If the answer is no, the activity is not reported. Government has to have control in this case. If the answer to the control question is yes, you assess whether it's for pension or OPEB. Answer is no. And then some of the flow chart here is cut off. But essentially, the government has to assess if the resources are from its own source revenue or for a pass-through grant for which the government has administrative or direct financial involvement. And in those cases, it's not a fiduciary activity. You get to a no response down on the cutoff section. If the answers to those questions are not no, then there's three categories of activities that qualify as fiduciary. and that is that the assets are held in trust or an equivalent arrangement, and the government is not a beneficiary. The second one is that the assets are for the benefit of individuals, and the government does not have administrative or direct financial involvement. And then the third is that the assets are for the benefit of organizations that are not part of the financial reporting entity. So the kind of short story here is that the government has to control the assets, but they can't be too involved in deciding how they're utilized, because in that case, they're not a fiduciary. They're, kind of directing something that it has too much responsibility for. Because to be a fiduciary, you're just holding something on another entity's behalf. There's a couple questions in the implementation guide that deal with student activity funds. Historically, we've seen these being very commonly reported as agency funds of the school boards under existing guidance. And there's two questions in the implementation guide that deal with if the school board has a formal policy over how the funds are used, or if we have a school employee who approves the expenditures, does that constitute direct or administrative involvement? And the answer to that question is yes. And so in these cases, and so in a lot of instances, schools may see these things that were previously accounted for as fiduciary activities no longer qualifying under 84 and needing to move out of what used to be an agency fund and being reported either as part of the general fund or a special revenue fund. Okay, so the fiduciary fund types, the first three that are here are what we're used to from before. So you have pension and other post-employment benefit trust funds, investment trust funds, private purpose trust funds, and then what used to be called agency funds are now custodial funds. That's where fiduciary activities that don't meet the other three categories are accounted for. So when there's no trust or equivalent arrangement, but you have funds held in a fiduciary capacity, they're reported in a custodial fund. And the other big change is that you now have to have a statement of changes in fiduciary net position for the custodial fund. When these were reported as agency funds previously, that changes statement was not required. But if your entity's been submitting their financial statements to the GFOA for their certificate program, you would have been preparing the equivalent of that statement for that program anyhow. So that may not be all that new to you. It just moves from being other information into the basic statements. For business type activities, nothing different really. You go through the same analysis to identify how the activities need to be accounted for. There is an exception for assets held for 3 months or less with a liability reported, not needing to be accounted for as a fiduciary activity. Other details, liabilities to beneficiaries should be recognized when an event's occurred that compels the government to disperse the resources. Example in the standard is that if a government's collecting taxes for another entity, there's really nothing that has to happen for that disbursement to occur. It's due at any time. So that should be reported as a liability when collected. And then the additions and deductions need to be disaggregated and reported at an appropriate level. That brings us to our first polling question. How prepared do you feel for implementing 84? If you didn't hear the intro, it's important to respond to the polling questions to get CPE credit. That's how we track attendance. So please make sure to respond to the poll if you would like credit for today's session. We have almost 90% of responses in. Good news is that most of you feel very or somewhat prepared. About 85% of you in that category. So that's very good since the standard's probably to be implemented for your current fiscal year. Okay, let's go ahead and close out the poll and move on. Okay. Next big standard, GASB 87, leases. And this one year after 84. So not top of mind, but right behind it, because there's a lot of background work that's needed to implement the standard and gathering and identifying all the lease arrangements that your government may have. Hopefully that's been going on for a while now, given how long the standard's been out and the preparation known that's needed to implement it. So the 1 year reprieve is helpful, but a lot of background work needed to make sure this one gets implemented correctly. So issued in June 2027, currently effective for reporting periods beginning after June 15, 2021. So June 2022 fiscal year ends and later. And again, the objective by the GASB, improve financial reporting. Big change here, the lease accounting as reported by governmental entities will very much mirror FASB accounting for everybody else. So when we used to have capital and operating leases, substantially all leases now are going to be treated as financing leases. A lease is a contract to control the right of use of an asset for a period of time in an exchange or exchange-like transaction. So, we've attached a formal definition to it, but it's what you expect it would be. So you have to be able to have use of the asset, and the government has to be able to determine the nature and use of the asset. So non-financial assets, what you would think it is, buildings, land, vehicles, equipment. There's some specific exclusions in the standard for animals. If you think of a zoo that might acquire things like that, there's others, but it'd be in most cases what you expect it to be. Control of the asset means that the government has to have the right to the service capacity and to determine how the asset's utilized. Okay, we're going to focus on lessee accounting in this session. Lessor, not as common, and the guidance is fairly straightforward. So for lessees, you're going to report a right of use asset, that's an intangible, as well as a liability for the present value of the future lease payments that are due. The asset's going to be amortized over the shorter of its useful life or the lease term, and the liability is going to be reduced by lease payments adjusted for interest. At initial measurement, the present value of the lease payments is recognized as a liability by the lessee, and then each time a payment's made, it's reduced, again, adjusted for the interest expense that should be recognized. So leases can be complicated. Most of them that you'll hopefully be dealing with will be straightforward and include, fixed payments at a stated rate. But if there's variable payments implicit in the lease, you calculate the liability based on what they are now. And then you also have to include other things if there's a reasonable certainty of them taking place. So if there's a residual value, purchase options, termination penalties, other incentives should be included in the initial calculation of the lease liability. Discount rate to be utilized, if there's a stated rate in the lease, that's preferred. It may be able to be determined based on what a purchase price would be and calculating the rate implicit in the payments. And then if those aren't available, the entity would use its incremental borrowing rate that it estimates. The lease terms, you start with a non-cancelable period, plus options to extend if there's a reasonable certainty of that happening, and adjusted for options to terminate if there's a reasonable certainty not to exercise. And the reasonable certainty concept is that the government should take into account the incentives or disincentives of exercising options. So would it be costly to extend or not extend a lease, what's the history of exercising those options, how important is the asset to the government. If it's a critical item that the government can't function without, that may make one more likely to believe that extension would take place, for example. And then if your leases have a fiscal funding clause, that should only impact the lease term if there's a reasonable certainty that it'll be exercised. So in most cases, those are included as sort of a formality and don't actually result in the termination of a lease. The lease term should be reassessed only if one of these events happens, if there's a option to exercise that wasn't expected by the lessee or the lessor, or if there's a termination triggered. So the lease asset recognized at the inception of the lease is going to be equal to the lease liability plus upfront payments made, plus direct costs incurred by the entity in executing the lease, and also adjusted for lease incentives. And then that asset's amortized again over the lease term or its estimated useful life, whichever is shorter. So summary of the lessee accounting, again, you're going to have an intangible asset recognized, lease liability, and then the lessor accounting is very similar. They have a lease receivable, of course, no liability, and a deferred inflow for the amounts that are due, and then that's adjusted when the payments are received. Disclosures, not anything out of the ordinary. General description of the lease arrangements, the value of the leased assets and amortized amounts, amount of outflows during the period for leases, disclosure of future payments that are due in 5 years individually, and then in 5-year buckets thereafter. And then if there are any commitments or impairments associated with the leases. There's a number of exceptions included in the standard for certain arrangements that aren't to be accounted for under 87. Short-term leases are excluded. That can only have a maximum possible term of less than 12 months, so no options to extend. And those are just recorded as payments are made. Regulated leases are excluded, so you see these commonly in airports. As I mentioned in the beginning, lots of background work required to identify leases. Luckily, there's several software products that are out there that will help with the actual implementation and generation of the entries that are needed. Second polling question, are you planning to use software to implement 87? %, of you have voted. I see a lot more no's than maybe we would have expected. So if you're not planning to, maybe you only have a small number of leases and it'll be easy to do using an Excel schedule, but think about it would be my advice. Okay, let's go ahead and close that down and move on. This is an easy standard, 89, accounting for interest costs. Most of you probably implemented it early because it was a rare instance of the GASB putting out something that made your lives easier. So we used to capitalize interest costs on certain constructed assets where there's debt or directly associated with the assets, or if there was existing debt, then that just stopped being the case. So no need to capitalize interest anymore on constructed assets. So if you haven't done that yet, it'll be easy once you do. Statement 90 on majority equity interests. I'm moving a little quick because I'm behind on time and need to let Laura take over. Definition behind this one, an investment is an asset that the government has to make a profit. So that's what we keep in mind. It's to make a profit and can generate cash. And so if a government has a majority equity interest in another entity that's a component unit, this standard clarifies how the reporting should take place. So if that asset is held by a fiduciary activity, so a pension or OPEB fund, or it's to be reported at fair value. If it's not in a fiduciary activity and it meets that investment definition, it's reported under the equity method. And if it doesn't meet the investment definition, it's simply a component unit of the entity. Okay, and then clarification on conduit debt obligations. These involve three parties. So you have the government, the debt holder, and then a third party who receives the proceeds of the debt and utilizes them for some purpose. And so this deals with the accounting by the government involved in the issuance. When there's a limited commitment, the issuer doesn't recognize any liability. And that limited commitment simply means that the issuer is going to maintain the tax-exempt status of the debt. If the government, as part of that issuance, has additional commitments, or it voluntarily commits to assume responsibility for the debt, if the third party defaults, then they recognize liability if certain criteria are met. That needs to be evaluated annually or when a triggering event occurs. So, if the government knows that the third parties incurred some sort of financial distress and that it's going to default, then the recognition should take place. There's also some arrangements that can involve conduit debt and the government constructing capital assets. And there's guidance on how those should be accounted for. The government may or may not report the capital asset depending on when it transfers to the third party. Disclosures for conduit debt, general description of the principal amount outstanding by type of commitment. And if there's a disclosure or a recognition that happens during the year, that would of course be disclosed with the details behind it. And with that, I will turn things over to Laura.
Hey everyone, good morning. My name is Laura Harden and I'm an audit director out of the Virginia Beach office with Cherry Beckert. So the first standard that I'll cover this morning is GASB 92. It's an omnibus standard. That just means it's covering a wide variety of different topics. The first one relates to GASB 87 and its effective date, but this has since been updated based on GASB 95, and the date that Stephen told you is the correct one. Second has to do with intra-entity transfers of assets, capital or financial, between a governmental employer, a non-employer contributing entity, and a defined benefit or pension plan, and the reporting of those, and that's applicable for fiscal years beginning after June 15th, 2021. The third item relates to the applicability of certain requirements under 84, those fiduciary activities that Stephen covered earlier, and just how you should apply the requirements within paragraph 21 of that. And it's applicable for periods beginning after June 15th, 2021. And then the last one is exceptions to acquisition value in a government acquisition, and when you're applying GASB 69 for measuring and recognizing that. That's applicable for periods beginning after June 15th of 2021. So the first real standard that I'm going to get into is GASB 93, and this is the replacement of the interbank offered rates, or IBOR. And it's applicable for reporting periods beginning after June 15th, 2021, except for paragraph 11B in the standard, which is applicable for reporting periods that begin after December 31st of 2022. However, as always, GASB really encourages earlier application. So the reason this standard is coming about is because there are some governments that have entered into agreements that have variable payments that are dependent on an IBOR. Most of us, I think, probably have heard of LIBOR, which is the London Interbank Offered Rate. And as a result of the global rate reference reform, it's expected that LIBOR is going to cease to exist in its current form at the end of 2021. And so that's prompting governments to amend or replace financial instruments to replace that rate with other referenced rates. So this standard they created to address the accounting and financial reporting implications that are going to result from replacing that IBOR. So there are some exceptions to this criterion when you would continue to go ahead and use hedging accounting. So if you have a hedging derivative that's amended or replaced to change the reference rate of that variable payment, or to add it or change a fallback provision related to the reference rate of a variable payment, if you also have a reference rate that's amended or replacing the instrument's variable payment, and that essentially equates to the same rate of the original instrument by either replacing the rate but being multiplied by a coefficient or adjusted by adding or subtracting a constant, or if you have an upfront payment that's made between the parties. Also, you need to have it where there's the replacement of the reference rate happens by ending the original instrument and entering into that new replacement instrument on the same date. And then you also need to have where the other terms that affect the changes in fair values and cash flows in the original or amended instrument are identical, except for the term changes that may be necessary for replacing those reference rates. So this does happen in a two-step transition. And the first step is going to be taking that IBOR and then replacing it with a new rate that's other than a secured overnight financing rate. And then after you have that new rate, then you can switch it to that SOFR. So I talked about an upfront payment. So an upfront payment is something that gets reported in as an asset if a payment is made, or it would be a liability if a payment's received. And that amount gets amortized using the interest method over the life of that hedged instrument. And similarly, you would have cash flows for that reporting period. So some of the appropriate benchmark interest rates that you can use are the interest rate on direct treasury obligations of the US government. You can also use an effective federal funds rate, or that SOFR, the secured overnight financing rate. LIBOR is no longer appropriate. So how is that going to impact your leases? So if you have a lease modification where it changes the interest rate for variable payments, but it's dependent on an IBOR, but you just have the amendment to just replace that rate, then you're not going to have a lease modification as a result. So GASB 94 is the public-private and public-public partnerships, the PPPs and availability payment arrangements. And it's effective for fiscal years that begin after June 15th of 2022 and all reporting periods thereafter. So what is a PPP? A PPP is an arrangement where a government, they also use the term transferor within the standard. They're contracting with an operator to provide public services by conveying the control of the right to operate or use a non-financial asset, something like your infrastructure or some other capital asset, for a period of time in an exchange or exchange-like transaction. So there are some PPPs that might also be service concession arrangements. And you would have a SCA, that's a PPP arrangement between the transferor and the operator, when the transferor is conveying the right and related obligation to provide services to that operator through the use and operation of that underlying PPP asset. And in exchange for a significant consideration, something like an upfront payment, they might have installment payments, a new facility, or improvements to an existing facility. So the operator then would also collect and be compensated by fees from the third parties. The transferor determines who determines or has the ability to modify or approve which services that operator is required to provide, who the operator is required to provide the services to, and also the prices or rates that can be charged for those services. And then the transfer is also going to be entitled to a significant residual interest in service utility of that underlying asset at the end of the arrangement. So last thing I want to point out here is that if you do have a PPP that meets the definition of a lease, then you're not going to follow GASB 94, you'd follow GASB 87 instead. So the term for a PPP is pretty similar to determine like the lease standard. So you've got that non-cancelable period, plus when you have any options to extend that are reasonably certain, or terminate that it's reasonably certain that you're not going to exercise those options. So just like with leases, you do need to assess all the relevant factors at the beginning of the term to make that best estimate of what the PPP term is going to be. So if you're the transferor, if you already have an underlying asset, you would continue to recognize that underlying asset. You're also going to be recording a receivable for those installment payments that are going to be received. And then you would have a deferred inflow. So any initial costs that you have would be reported as an outflow of resources or an expense when they occur. And these could be things like costs that are incurred to set up the PPP that would not have been incurred otherwise. And then your receivable is going to be for those installment payments that initially get measured at the present value of those payments expected to be received during the term. And then they get reduced for any provision for estimated uncollectible amounts, and then they get amortized. Your deferred inflows are the sum of all assets that are going to be recognized, and then those get recognized in a systematic, rational manner over the term of the PPP. So disclosures for the PPP on the transfer side, pretty similar to what we see for most other disclosures. You've got your general description, you've got to disclose what your assets and deferred inflows are, what discount rate you used, what inflows you had during the year. And if you have any rights that are retained by the transfer or granted to the operator, those need to be disclosed as well. On the operator side, if you have an existing asset, then you would recognize a liability for the installments made that are going to be made, and an intangible right to use asset. So the liability for the installment payments initially get measured at the present value of those payments that are expected to be made and then are going to be amortized. And that right to use asset, that's basically the offset of the other amounts that are recorded at the start of your term. And then that gets amortized over the shorter of the term of the PPP or the useful life of that PPP asset. Disclosures for the operator, very similar to what you're disclosing on the transfer side, but if you do have any kind of impairment, that needs to be disclosed in your footnotes as well. That brings us to our third polling question. This one's a little bit more fun. So does anybody have any summer vacation plans? I think we all missed vacation last year, so hopefully people are starting to travel again or have something to look forward to. And it looks like at least 50% already have plans, and the majority that don't are working on their vacation plans. And we have one person who's already traveling right now, so very jealous of you. Okay. Okay, so GASB 96 is subscription-based information technology arrangements. This standard's effective for fiscal years beginning after June 15th, 2022. So what is an SBITA? It's a contract that conveys control of the right to use another party's IT software, either alone or in combination with tangible assets as specified in the contract for a period of time in an exchange or exchange-like transaction. So definition for this in the PPP and the leases, they all have the same definition of control pretty much. So if you would have control if you have that right to obtain present service capacity from using the asset and to determine how that asset is used. If the contract is solely to just provide IT support services, then it's not covered under this statement. And then similarly to leases, a short-term SBITA would be anything that has a maximum possible lease term of 12 months or less, so meaning you don't have any options to extend past the 12 months. So the term of the lease, very similar to the term for the leases and PPPs, you've got that non-cancelable period, plus your options to extend or terminate. Now, under this standard, you would be recognizing a subscription liability and an intangible right to use asset called your subscription asset. And that subscription liability gets measured at the present value of the subscription payments that are expected to be made during the term, and they get amortized and reported as an outflow of resources as interest expense. The asset gets measured as the amount of the initial measurement of the liability, plus if you have any payments associated with the contract that get paid to the vendor at the start of that agreement, if you've got any capitalizable initial implementation costs, and then you take out any kind of vendor incentives. That amount gets amortized as a deferred outflow as your amortization expense in a systematic and rational manner over the shorter of the subscription term or useful life of the IT asset. So there are 3 stages of implementation here. The first being your preliminary project stage. And when you're in the preliminary stage, any items get expensed as they're incurred. Then in your initial implementation, those would generally be capitalized and as an addition to that subscription asset. And then during the operation and additional implementation stage, generally those are going to be expensed unless they meet specific criteria for capitalization. Just a few other things that get covered under this standard is regarding if you have any kind of impairment. If you do have an impairment, then that amount gets, the amount of the subscription asset would be reduced for any change in the related liability, and the remainder would be recognized as an impairment. Any kind of incentives provided to the SBITA vendor, those amounts would reduce the amount the transferor is required to pay for the SBITA. And as discussed earlier, those are noted at the beginning of the term and reduce the amount of that subscription asset. If you've got something that has multiple components, the contract price would need to be allocated to the multiple different components. Contract combination. So if you enter into a contract either at or near the same time with the same vendor, then those contracts are able to be combined if they're negotiated as a package that have a single objective, and the amount being paid is dependent on the price or performance of other contracts. So disclosures here, I'm not going to go into them because they are basically very similar to the lease and PPP disclosures that have to get reported. So GASB 97, this is certain component unit criteria in accounting and financial reporting for IRC section 457 deferred comp plans. So this standard, if you meet those certain criteria, it's effective immediately. If you have the section 457 plans, that's applicable, effective for fiscal years beginning after June 15th of 2021. Excuse me. So for the certain criteria, if you've got the absence of a governing board in determining financial accountability, so when you're determining whether a primary government's financially accountable for a potential component unit, if the primary government performs the duties that a board typically would perform, the absence of that board, governing board, should be treated as the same as an appointment of a voting majority of the governing board. And then the applicability of the financial burden criterion in paragraph 7 of 84 is only applicable for defined benefit pension plans and OPEB plans that are administered through trusts that meet those certain criteria in paragraphs 3 of 67 and 74. So for section 457 plans, those are either going to be classified as a pension or OPEB plan. And for plans that meet the definition of a pension plan, those will be included in the financial statements of another government or issue standalone financial statements. Then all accounting and financial reporting requirements would be requirements that are relevant to those pension plans would be applied. So this brings us to our last polling question, just whether or not you're still working from home. if you can tell, I am not at my house, I'm at the office, but I do spend probably half my time in the office now, half working from home. And looks like we're almost about a third split. Okay, the last thing I'm going to cover are the various GASB projects that are going on. So as far as major projects, the first two here are regarding the conceptual framework and recognition and disclosure. So in these two projects, they're working on developing recognition criteria for whether information should be reported in the financial statements, as well as when it should be reported, and then also development and evaluation of notes to the financial statements to improve the effectiveness of note disclosures. The next item is the financial reporting model, which is where they're looking back at GASB 34, and probably nobody is looking forward to, if they come to a conclusion on this, having to redo things. But what they're looking at currently is maybe looking at making debt service a major fund. They're looking at the requirements and location of budgetary comparisons, schedules, as well as potentially adding in a entity-wide cash flow statement. Lastly, regarding revenue and expense recognition, so they're working to develop a comprehensive principles-based model that establishes categorization, recognition, and measurement guidance applicable to a wide range of revenue and expense transactions. So some of the practice issues that they're looking at are, the first one's related to compensated absences, where they're trying to address certain issues related to accounting and financial reporting for compensated absences. This is going to include addressing certain types of accrued leave benefits that aren't covered currently under GASB 16, measurement options for sick leave, and the usefulness of the required notes. The Implementation Guide 2021 update, they're updating implementation guidance for additional issues that have come to their staff. The omnibus is just where they're going to be addressing various technical corrections and other practice issues that have been identified. Prior period adjustments, accounting changes and error class corrections. They're working to improve the accounting and financial reporting for items including inconsistency within the practice, confusion about and difficulty in applying those requirements, and then also the usefulness of the disclosures surrounding these items. Renaming the comprehensive annual financial report. So they're looking at whether a new name should be established, and if so, what that should be. We're no longer using the term CAFR, so I think we're all trying to remind ourselves that we need to say it a little differently. Lastly, risks and uncertainties disclosure. So just identifying potential risks and uncertainties and developing those required disclosures. And then just lastly, some pre-agenda research looking at capital assets and those standards applicable to it and reporting, going concern, making sure that there's appropriate literature and guidance out there, some interim financial reporting, and then non-financial assets, determining what the effect that those have on financial reporting. And that brings us to the end of our presentation.
All right, so thank you, Laura. Thank you, Stephen. I just want to thank everyone for attending our session today. This does conclude our first session of the seminar. We do have 3 more sessions subsequent to this. You will need to log out and click on the link to that next session. So our next webinar is the COVID update. It will begin at 10 a.m. Thank you so much for your feedback. We hope you'll take part in the survey that will be sent to you. Also a reminder that we will be sending a copy of the PowerPoint and a link to this presentation to you within about the next week. So thanks for your attendance today. We will see you soon.